Welcome to the Deep Dive. We're here to cut through the noise and really get to the heart of what's going on behind the headlines. Today, we're putting Macy's, Inc. under the microscope. One of America's most iconic retailers. Everyone knows the name, the flagship stores, the parade. But the real question is, how does a giant like that, a century-old institution, reinvent itself, especially now in this digital-first world? Well, their answer seems to have come in early 2024. They launched this huge 3-year strategy called A Bold New Chapter. And we've really dug into their latest annual report for 2024. That's the Form 10K, dated February 1st, 2025, to pull out the key insights. So our mission today is basically to peel back the layers on how Macy's is actually changing, what the financials underneath it all really tell us, and what this might mean for their future, and maybe even for the future of physical retail itself. So to really get a handle on Macy's journey right now, we've got to understand this bold new chapter strategy. It's not just like a minor adjustment.
You're aiming to fundamentally reposition the whole company, really challenge how things have always been done, and build a much more modern business. And it seems to rest on three main pillars. First, strengthening and kind of reimagining the main Macy's brand. Second, accelerating and differentiating their luxury offerings. And third, simplifying and modernizing operations from end to end. The big goal, according to their report anyway, is sustainable, profitable growth, all wrapped up in a better shopping experience, whether you're online or in-store across all three brands, Macy's, Bloomingdale's, and Bluemercury.
Right. And what's really striking is how deliberate they seem to be with each of those pillars. They clearly understand that retail today demands constant strategic shifts. So for that first pillar, strengthening and reimagining Macy's, they've made some pretty bold moves already. They talk about right-sizing the store base, which basically means getting rid of stores that aren't pulling their weight. In 2024, they closed 64 stores. They had targeted about 150 non-go-forward locations, and their initial goal for the year was 50 closures, so they actually exceeded that. And this isn't just about stopping the bleeding, it's a strategic divestment. It generated $283 million in asset sale proceeds, money they can now reinvest. It shows they're being quite aggressive about shedding that dead weight, which is, a big shift from maybe how some legacy retailers operated in the past, clinging on to unproductive locations.
Yeah, holding on too long. But they're not just closing stores, right? They're also investing in the ones that are working.
Exactly. They have these first 50 pilot locations. These are stores where they're testing things like better staffing, improved merchandise assortments, visual presentation, that kind of thing. And these delivered 4 straight quarters of positive comparable sales growth. That's comparing sales year over year in the same store, so it's a good measure. They were up 0.8% for the parts Macy's owns directly, and 1.2% if you include the licensed departments inside those stores. So a positive impact across the board there. And crucially, these stores also hit record annual Net Promoter Scores NPS, which measures customer loyalty, up 160 basis points, so 1.6 percentage points from 2023.
Okay, so that suggests a better customer experience in those specific stores. The big question then is, can they actually roll that out successfully everywhere else?
That's the million-dollar question, isn't it? Alongside that, they're also changing up their merchandise, more variety, less redundancy, and a big push on their private brands. On 34th, State of Day, those are newer lines, plus refreshing older ones like INC and Style & Co. And then there's digital. They've worked on site navigation, search functions, introduced a more competitive pricing algorithm, and all that led to digital sales getting back to positive comparable growth in the fourth quarter, which is vital because digital made up 33% of their total net sales in 2024.
Wow, a third of sales online. That's huge.
Yeah.
And consistent with previous years, you said. So it's clearly a core part of the business.
Absolutely. It's not just an add-on anymore.
So while the main Macy's brand is adapting, it sounds like their luxury segments, Bloomingdale's and Bluemercury, might be leading the charge a bit in this new chapter. How are they doing on that second pillar, accelerating luxury?
Yeah, it definitely seems like luxury is a key growth area for them. Bloomingdale's, for instance, got back to positive annual comparable sales, up 2.5% if you include owned, licensed, and their online marketplace sales together. They even had their best fourth quarter comparable sales ever, which is pretty impressive in the current climate.
That is impressive.
And just like the Macy's pilot stores, Bloomingdale's also hit record annual Net Promoter Scores, up 90 basis points from 2023. So customers seem happy in that luxury segment too. What's also interesting is their expansion strategy there. They opened 3 new Bloomingdale's stores and 2 Bloomingdale's The Outlet locations in 2024. They're focusing on smaller formats, bringing that count up to 27.
That makes sense. A smaller footprint, maybe easier to manage and place in different locations. And what about those partnerships? I saw something about a wicked collaboration.
Ah, yes, that was a big one. An exclusive collaboration tied to the movie. Apparently, it generated something like 15 billion media impressions.
15 billion, wow.
Yeah, they said it was 3 times higher than their previous holiday campaign.
Okay, that's massive exposure. But is that sustainable or more of a one-hit wonder kind of marketing thing?
It's definitely a high-impact branding move. It shows they can tap into cultural moments. It might not drive sales directly over a long period, but it builds relevance, gets eyeballs on the brand, helps pull people into their world. And speaking of their world, Blue Mercury, their beauty chain, turned 25. They revamped the website, updated the store design, and they've just been incredibly consistent. Their 16th straight quarter and 4th straight year of positive comparable sales growth, up 4.0% on an owned basis in 2024. They opened 17 new stores and remodeled 7 more just last year. Blue Mercury is really a solid performer in their portfolio, shows the strength of specialized retail.
Okay, so strong performance in luxury, strategic moves in the core brand. But none of that works without the engine running smoothly behind the scenes. What about that third pillar, simplifying and modernizing operations?
Exactly. You can have the best strategy, but if the execution isn't there. So Pillar 3 is all about efficiency. They managed to cut their selling, general, and administrative expenses, SG&A, by $45 million in 2024. That shows some real cost discipline.
Okay, $45 million saved. That's not insignificant.
No, definitely not. And they've also gotten better at fulfilling orders. The percentage of orders delivered within 5 days went up by 400 basis points. That's 4 percentage points. And they cut the time it takes from order to shipment by about 1,100 basis points. Plus, product availability improved by over 400 basis points, too.
So faster shipping. Stuff is actually in stock more often. Sounds like basic blocking and tackling, but stuff that really matters to customers.
Absolutely. It's the fundamentals. And they're investing in the future of that, too. They've got a huge new distribution center coming online in China Grove, 1.4 million square feet. It's supposed to start operations mid-2025 and will use a lot of automation. Should help streamline things across all 3 brands. And, of course, technology. They mention actively using things like predictive analytics, machine learning, AI, even generative AI. The goal there is to cut complexity, save costs, and improve the customer experience. It's trying to make the whole operation smarter and more efficient.
Right, integrating tech not just for show, but for actual operational gains. Okay, so we've covered the strategy, the brands, the operations. Let's get into the financials. How did all this translate to the bottom line in 2024? Their net sales landed at $22.3 billion. Now, that was down about 3.5% from the $23.09 billion in 2023. But it's important context, right? 2023 had that extra 53rd week, which added, what, $252 million? So the comparison isn't perfectly clean.
Exactly. That 53rd week makes a difference when you're looking at the year-over-year percentage change.
Right. And comparable sales for the whole company were down 2.0% on an owned basis, or down 0.9% if you include licensed and marketplace stuff. For the Macy's brand specifically, comps were down 2.6% owned. Though their go-forward business, those better pilot stores plus digital did slightly better, down 2.4%. So still down, but less so.
Still negative, but maybe showing some relative strength in the areas they're focusing on.
Perhaps. On the brighter side, their gross margin held steady at 38.4% of net sales, flat from 2023. That seems pretty good, right? Keeping profitability per sale stable during the transformation.
It really is quite good. Maintaining gross margin is crucial. Their actual merchandise margin dipped just slightly, 10 basis points, which they said was due to product mix and an accounting change. But that was offset because they had less inventory shrinkage, partly thanks to better asset protection and liquidations.
Okay, so managing inventory well helped offset other pressures.
Yeah.
And they generated nearly $1.3 billion in operating cash flow and ended the year with $1.3 billion in cash. That sounds healthy.
Yeah, strong cash flow generation and a healthy cash balance, up $272 million from the end of 2023. That gives them flexibility.
Now, here's the part that might trip people up. Net income was $582 million. That's a massive jump from only $45 million in 2023. And diluted earnings per share, EPS, followed suit. $2.07 was just $0.16. Huge increase. but their adjusted diluted EPS was $2.64, which is actually down from $3.28 in 2023. How can net income shoot up while adjusted EPS goes down? Can you unpack that for us?
Yeah, that's a really important distinction, and it catches people out sometimes. It boils down to one-time items or things outside normal operations. The huge jump in reported net income from $45 million to $582 million, while adjusted EPS fell, is mostly because of much lower impairment, restructuring, and other costs in 2024. Those costs were only $171 million last year, compared to over $1 billion, $1.027 billion in 2023.
$1 billion in costs in 2023. Wow. What was that from?
Mostly non-cash charges related to writing down the value of assets, mainly stores they decided to close as part of the restructuring. So the adjusted EPS number pulls out those huge, unusual charges to give you a clearer picture of the underlying ongoing operational performance. And that underlying performance, on an adjusted basis, did decline year over year.
Okay, that makes sense. So the big net income jump was more about cleaning up the books from past decisions, not necessarily a surge in current core profitability.
Precisely. It's crucial not to confuse the two. Now, looking at other revenue streams, their credit card income actually fell by $82 million, or 13%, down to $537 million. They cited higher credit losses as the main reason. That could reflect, broader economic pressure on consumers.
Yeah, that's a potential headwind.
But on the flip side, their Macy's media network, MMN, basically selling advertising, grew quite nicely, up $21 million, or 14%, to $176 million. That's driven by more vendors participating, more advertisers. It's a relatively new but growing income stream for them, leveraging their customer data and traffic.
Interesting. Monetizing the platform itself. And what about the overall balance sheet? Still looking healthy?
Yeah, pretty solid. They ended the year with over $1.3 billion in cash, as you mentioned. Total assets were slightly up at $16.4 billion. Inventory was up a bit to $4.468 billion. And they actually changed how they value inventory in 2024, switching to the LIFO method, last in, first out. It's a technical accounting change, but they say it provides better accuracy and transparency and aligns them with industry practice. They still emphasize strong inventory discipline, though.
Okay. And capital expenditures, where the money go?
CapEx was $882 million in 2024, mostly funneled into digital technology, and those omni-channel improvements we talked about really reflects that investment phase of the bold new chapter.
Right, putting money behind the strategy. Which brings us to shareholder value. Amidst all this spending and transformation, how are they planning to reward investors? They lay out their priorities pretty clearly. First, keep the balance sheet healthy. Maintain investment-grade credit ratings, stability first. Second, invest in the business for that long-term growth, the CapEx we just discussed. And third, return capital to shareholders, dividends and share buybacks.
And on the dividend front, they've been consistent. They returned $192 million to shareholders via quarterly cash dividends in 2024. That included a 5% per share increase from 2023. The quarterly payout went up from 17.37 cents to 18.24 cents starting in Q1 2025. So they're signaling confidence by increasing the dividend even slightly, though of course future dividends are always up to the board.
Okay, a steady and slightly growing dividend. What about share buybacks? Buying back stock can also boost shareholder value. They had that big $2 billion authorization from way back in February 2022, and there's still $1.4 billion left on it as of the start of this year. But interestingly, they didn't actually repurchase any shares in 2024. They did $25 million worth in 2023, but zero last year. Why the pause, do you think?
It likely signals a focus on conserving cash during the heavy investment phase, or perhaps prioritizing debt reduction, shoring up the balance sheet first.
Makes sense.
Yeah.
But they do expect to resume buybacks in 2025.
That's what the report indicates, yes. Resuming buybacks in 2025 alongside maintaining the dividend, so signaling a return to broader capital return.
Okay. And speaking of the balance sheet, what about debt? How are they managing that?
Their total debt was around $2.78 billion at the end of the fiscal year, and they were actively managing it. They did a tender offer back in September 2024, where they used cash on hand, about $225 million, to buy back $221 million worth of their senior notes, basically paying off some debt early.
Proactive debt reduction then.
Exactly. And another sign of strong liquidity, they had nothing drawn on their $3 billion revolving credit line, their main corporate credit facility at year-end. So plenty of borrowing capacity if needed.
All right, so looking ahead to 2025 and beyond.
Yeah.
How are they framing the next steps? Still full steam ahead on the bold new chapter. It sounds like the priorities are customer focus, operational excellence, and pushing forward with the strategy, but maybe with more deliberation. They mentioned continuing to rationalize the Macy's store base, focusing investment on the go-forward parts of the business, and crucially, managing capital efficiently. They're actually guiding for lower capital expenditures in 2025, around $800 million. Still focused on digital, tech, key stores, and omni-channel, but maybe a slightly less intense spend.
That seems right. Potentially moving from the peak investment phase into more targeted spending and focusing on execution and cash flow generation. But, it's crucial to remember the risks. The 10K lays them out clearly, as they always do. Macroeconomic stuff is huge: inflation, interest rates, economic uncertainty, geopolitical issues. All that can hit consumer spending, especially on discretionary items.
Yeah, retail is always sensitive to the economy.
And competition is fierce. Online players, off-price stores, specialty shops. Macy's has to constantly fight to stand out. Consumer behavior keeps changing, too. They need to stay on top of trends, demands for personalization, sustainability concerns. Supply chain risks are always there, labor issues, geopolitical tensions like U.S.-China trade potentially raising costs, even natural disasters.
Cybersecurity, too, right? Always a threat.
Always. Bigger threats, potentially huge costs if there's a breach. They detail their security measures, but the risk never goes away completely. Plus, challenges in attracting and keeping good employees, wage pressures, and even potential hits to their credit card income from changing payment habits or new regulations, like that proposed CFPB rule on late fees.
Right, that $8 late fee cap could definitely impact credit card revenues if it goes through.
It could. So yeah, lots of external factors they have to navigate successfully on top of executing their own internal strategy.
It's certainly a complex picture. What an interesting journey we've taken through Macy's reinvention efforts. You really get a sense of how this legacy retailer is trying to navigate a massive transformation, closing stores strategically, investing in new formats, pushing digital, managing the finances. It really is a testament to how even the biggest, most established names have to adapt constantly just to survive and hopefully thrive. So, as Macy's pushes forward with this bold new chapter, changing its physical shape, adopting tech like AI, trying to connect with customers old and new, what does this really tell you? What does it say about the resilience, maybe the potential for reinvention of traditional brick-and-mortar retail in a world that feels increasingly digital? How might these choices that Macy's is making now end up shaping not just their own future, but the wider retail landscape we'll all be shopping in down the road? Something to think about.